Section 1. The market's shocking week, oil war and a wall of worry. Oil war, a wall of worry. The global financial markets have just weathered one of their most turbulent weeks of the year, leaving investors on edge and searching for answers. The sudden and sharp escalation of geopolitical tensions involving Iran sent immediate shockwaves across trading floors from New York to Tokyo. This wasn't a slow, creeping uncertainty. It was an abrupt jolt that reverberated through every asset class. The primary catalyst for this widespread panic was the dramatic surge in oil prices. This spike in energy costs immediately raised alarms about the stability of the global economy. The numbers from the past week paint a stark picture of the market's anxiety. On one particularly brutal day, the Dow Jones Industrial Average plummeted nearly 800 points. U.S. crude oil prices experienced their most significant single-day gain since May 2020, jumping an astonishing 8.5% to settle just above $81 per barrel. This wasn't just a minor fluctuation, it was a seismic shift. The conflict has already led to the suspension of almost 1/5 of the global crude oil supply. Investors watched their screens in disbelief as gains evaporated and volatility gauges spiked to levels not seen in months. This sudden volatility has forced a critical question to the forefront of every investor's mind. Are we merely witnessing a temporary, albeit painful, market tremor? Or is this the beginning of a much larger and more sustained correction? The answer remains uncertain, hanging precariously on the geopolitical developments in the Middle East. The situation is incredibly fluid, with new headlines emerging daily that could either calm the markets or send them into another tailspin. For now, the prevailing mood is one of extreme caution, as the world holds its breath to see if diplomacy can de-escalate the conflict before it inflicts more lasting economic damage. In this analysis, we will delve deep into the mechanics of this market shock. We will break down exactly what transpired this week, exploring the three major factors that drove the sell-off: a surge in oil prices, geopolitical turmoil, and renewed fears of persistent inflation. We will also examine why developments in the Middle East, particularly concerning the Strait of Hormuz, have such a disproportionate impact on global markets. Finally, we will turn our attention to the strategies that savvy investors are considering in this environment, specifically focusing on why dividend-focused investments, like the popular ETF SCHD, are gaining significant attention right now. Section 2. Finding shelter in the storm. Why investors are turning to dividends. In times of extreme market turbulence, a predictable pattern often emerges among investors. The frantic chase for high-flying growth stocks gives way to a more conservative flight to safety. When uncertainty reigns and fear grips the market, the focus shifts from speculative gains to capital preservation and reliable income streams. This is precisely the environment we find ourselves in today. The recent volatility has triggered a significant rotation into what are known as defensive sectors: consumer staples, healthcare, and utilities, which tend to perform more steadily regardless of the broader economic cycle. People still need to buy groceries and medicine, even during a market panic. This defensive shift naturally leads many investors to rediscover the appeal of dividend-paying stocks. These are typically shares in mature, well-established companies that have a long history of distributing a portion of their profits back to shareholders. Unlike stock price appreciation, which can be unpredictable and subject to wild swings based on market sentiment, dividends represent a tangible, regular cash return on an investment. This consistent income can provide a much-needed psychological and financial cushion when portfolio values are declining, helping investors to stay the course instead of selling in a panic at the worst possible time. One of the most popular vehicles for accessing a diversified portfolio of these dividend-paying companies is the Schwab U.S. Dividend Equity ETF, known by its ticker symbol SCHD. This particular fund has become a focal point for investors during the recent market upheaval for a specific reason: its underlying strategy. SCHD doesn't just hold any company that pays a dividend. It specifically tracks an index of high-quality U.S. companies. that have demonstrated a decade-long track record of consistent dividend payments, possess strong fundamental financial health, and have robust earnings profiles. This disciplined approach is designed to find stability in a sea of chaos. As we navigate the current landscape, understanding funds like SCHD becomes crucial. Its portfolio construction, which includes significant exposure to the energy sector, positions it in a unique way during an oil price shock. While many parts of the market suffer from higher energy costs, SCHD's holdings in major oil producers could actually benefit. This analysis will explore why this specific dividend strategy is attracting so much capital right now, how it can act as a shield against volatility, and what investors need to watch for as we head into a period of heightened uncertainty, including key market dates in late March that could introduce even more volatility. This week's market turmoil wasn't driven by a single issue, but by a powerful and interconnected trio of factors that hit investors with brutal efficiency. The first and most immediate driver was the alarming spike in oil prices. Following the escalation of the conflict involving Iran, U.S. crude prices surged, more than 20% this week alone, an almost unprecedented climb outside of a major global crisis. This wasn't a gradual increase, it was a violent repricing of the world's most critical commodity. The conflict has directly led to the suspension of nearly 1/5 of the global crude oil supply, a massive disruption that sent shockwaves through energy markets and immediately raised the cost of doing business for nearly every industry on the planet, from airlines to manufacturing. The second factor, inextricably linked to the first, is the geopolitical escalation itself. Markets despise uncertainty, and the current situation in the Middle East is the very definition of it. With reports of drone strikes and shipping disruptions near the Strait of Hormuz, a vital choke point through which roughly 20% of the world's oil supply travels, investors are being forced to price in a significant risk premium. The conflict, which has seen nearly every country in the region sustain some form of damage, has left ships stranded and producers taking precautionary measures. For instance, Kuwait announced it would reduce its oil production as a safety measure, further tightening the already squeezed supply and amplifying fears of a prolonged and wider conflict. Finally, these two elements have resurrected a ghost that investors and central bankers have been desperately trying to banish: the return of rampant inflation. Higher energy prices act as a direct tax on the global economy. They immediately translate to higher costs for transportation, manufacturing, and ultimately, consumer goods. Just as it seemed inflation was beginning to cool, this new energy shock threatens to reignite it. This complication puts central banks, particularly the U.S. Federal Reserve, in an incredibly difficult position. The prospect of renewed inflation could force them to keep interest rates higher for longer, a scenario that puts downward pressure on stock valuations and chokes off economic growth. These three factors, soaring oil, geopolitical chaos, and resurgent inflation fears, have created a perfect storm for financial markets. They are not separate issues, but a tangled web where each problem exacerbates the others. This dangerous feedback loop is what turned a regional conflict into a global market headline, leaving investors to grapple with the fallout and question whether their portfolios are prepared for the sustained pressure that may lie ahead. The market's short-term reaction to this triple threat was swift, decisive, and overwhelmingly negative. As news of the escalating conflict flashed across trading terminals, a wave of sell orders flooded the market. The Dow Jones Industrial Average experienced a staggering drop, closing lower by nearly 800 points. It had briefly tumbled more than 1,100 points during the day's trading session. This wasn't a calm, orderly retreat. It was a panicked rush for the exits. The VIX index, the market's fear gauge, soared as traders scrambled to buy protection. Energy market moves were even more dramatic. U.S. crude oil posted its largest single-day gain in over 2 years, up 8.5% to just over $81 per barrel. The market treated it as a real supply problem. Qatar declaring force majeure on natural gas exports. Nearly 9 million barrels per day taken off the market due to damaged facilities or precautionary shutdowns. Markets react first and ask questions later. The initial sell-off was driven by algorithms. Traders were also selling fast. Keywords were triggering trades. Conflict. Keywords: oil disruption. Keywords: Strait of Hormuz. Risk reduction was the immediate goal. Portfolio managers feared prolonged high energy prices and economic slowdown. They began shedding volatile assets, especially high-growth tech. The selling was broad-based. This looked like systemic risk. Markets became a minute-by-minute referendum on headlines. News of de-escalation sparked quick rallies. New disruption reports triggered fresh selling. The Dow partially recovered from its 1,100-point low to a 785-point loss. Buyers stepped in. But overall tone remained pessimistic as the market braced for ongoing volatility. Section 1. Navigating the Fog of War. Key takeaways for investors. As we draw this analysis to a close, it's clear recent market turmoil has ushered in a new and highly uncertain chapter for investors. The sharp escalation of conflict in the Middle East has acted as a powerful catalyst, unleashing a trio of risks: a severe oil supply shock, heightened geopolitical instability, and the unwelcome return of inflationary pressures. The immediate and brutal market reaction, with steep index declines and a dramatic spike in volatility, underscores the gravity of the situation. This is not a time for panic, but for clear-eyed assessment and strategic positioning. Core takeaway: the market's direction will be dictated by three critical signposts. First, the price of oil. Second, vigilant monitoring of Middle East geopolitics. Every diplomatic headline, military maneuver, and statement from regional powers will be scrutinized. Finally, the resulting inflation data and the subsequent signals from the Federal Reserve. The central bank's response will determine the path of interest rates and the valuation landscape for all financial assets. We've seen a flight to quality, with many investors shifting to defensive strategies to shield their portfolios. The Schwab U.S. Dividend Equity ETF, SCHD, has emerged as a key vehicle in this rotation. Its strategy of targeting financially sound companies with a long history of paying dividends offers a compelling blend of income and stability. SCHD's significant weighting in the energy sector has positioned it to potentially hedge current risks, providing a potential hedge against the forces battering the broader market. However, it is crucial to approach any single investment with a degree of caution. The upcoming portfolio reconstitution in late March could see a rebalancing away from the energy stocks that have driven its recent outperformance. Investors should see it not as a magic bullet, but as a component within a broader, diversified strategy designed to provide income and a defensive posture. Section 2. The road ahead. Your strategy for the coming weeks. First, monitor the oil futures curve. This will show if the market thinks this is a short-term crisis or if it's pricing a protracted conflict. Second, watch upcoming dividend announcements and key market dates. Knowing this calendar helps avoid impulsive moves. Third, listen to Federal Reserve officials' language. Are they prioritizing fighting inflation or showing concern about the energy shock's hit to growth? We stand at a critical crossroads. Will markets absorb the shock and recover, proving historical resilience, or are we headed toward a bigger, painful correction? Now, I want to hear from you. Recover quickly or bigger correction? Tell me in the comments below.